About to get started here. I want to make sure everybody can hear me. If you can hear me, just type a Y or a yes or hey Josh, what's up in the box, and we'll go ahead and get started here. It sounds like, yep, there we go. Yes, yes, yes. Very, very cool. Okay, folks, so here's what we're going to do. We're going to be introducing a good friend of mine, Jesse Colombo. He is an economic analyst and a Forex trading instructor with Cyber Trading University. Now, here's something that's really, really cool that you guys need to understand. Back, you guys remember the housing and credit bubble that burst in 2008? When he was a university student, he actually warned about that entire crash happening. So this guy's knowledge and information and understanding of the markets in general, when he says something's going to happen, something's going to happen. So we're going to talk today about how to profit in the coming bear market. Listen to what this dude talks about. It's going to be some great information. Jesse, are you there?
Yes, I am.
Alrighty. Well, folks, you guys are going to love this. Sit back and make sure you take some notes. And we're looking at some massive changes happening out here in the coming market. And so Jesse's going to show you what's going to go on and how to position yourself to come out profitable. So Jesse, take it away.
Thank you so much, Josh, for having me and for the kind intro. And I think this topic could not be more appropriate for what's happening in the world today. And I'm going to be discussing a lot of my research and how it applies to what's been happening and unfolding this past summer. And let me just adjust my volume. Is this okay? Please let me know if the sound is good. I always have to readjust my microphone. Thank you so much. Anyway, so what I'm going to be discussing is very relevant to what's been happening and unfolding this past summer, and I'll also be discussing how it relates to forex as well as ways to profit from it. So I think it's going to be very exciting, and hopefully I don't scare you all too much. That's not my goal here, by the way, but I'll explain my philosophy shortly. So today's presentation is called "How to Profit in the Coming Bear Market," and bear market can be interpreted as a financial crisis as well as bear market in risk assets like stocks and so on, basically economically sensitive assets. But first, want to just discuss our quick risk disclaimer. The idea here is that all forms of trading, whether it's futures, forex, stocks, is risky. So Cyber Trading University and myself are not recommending that you place any specific trades. Everything we're teaching today is for educational purposes. So I just want to discuss myself. My name is Jesse Colombo, and I'm an independent economic analyst and researcher. And I was recognized by the London Times in 2008 for warning about the global financial crisis starting in early 2004. And as Josh said, I did that as a university student, and I was involved with the financial markets myself starting in high school, just studying it and dabbling and trading. And through that research, I discovered that the United States was experiencing a bubble, a speculative bubble in property, housing, and in related sectors, as well as in debt. So I basically took it upon myself to build a website to warn about it. It was called stockmarketcrash.net. I still own the website. And by 2005, this became one of the foremost highly trafficked housing bubble related websites according to the LA Times. So I was just a college student when I was running this website, and then when everything burst, that's when I became recognized for having warned about it. And interestingly, since 2011, I've noticed new economic bubbles developing around the world. I call them post 2009 economic bubbles. So I'll be discussing what those bubbles are today in coming slides. And I built up a very large social media following of over 100,000 followers because I was warning about these bubbles in recent years. And then about a year and almost 2 years ago, actually, Forbes magazine contacted me and wanted to see if I'd like to write a column for them on their website, Forbes.com, which I've been doing ever since then. I discuss economic bubbles as well as the trading implications of those bubbles. And then I've partnered with Cyber Trading University to teach trading, various forms of trading, including intraday stock trading, forex, futures, etc. So just want to get into the meat of the topic of today. It's the whole idea of this economic recovery. I know this is a concept and a term that's been thrown around a lot in the media. You know, the whole recovery, is the recovery real? Is the recovery strong enough? So on and so forth. here's my concern, and this is what I've been saying publicly for the last few years, and I believe recent events are proving this to be true, that our recovery is, even though jobs are being created, even though economic growth is rising, even though financial markets are going up, I believe that it's a sham, basically. I believe it's not a real recovery, but what I call a bubble recovery. That's a term that I've coined. It's actually in Investopedia and Financial Times, financial dictionary, basically. It's an actual word that's become quite popular. And the idea behind it is that it's an economic recovery that's driven by bubbles, inflating dangerous bubbles. And bubble recoveries are driven by debt and overvalued assets. Now, economic bubbles, including stock and housing bubbles, do create temporary growth. Last decade's housing and debt bubble in the United States, the one that I also warned about, actually created a lot of artificial jobs and economic activity in sectors that are related to those bubbles. They were real jobs. People were getting paychecks. We saw GDP numbers improving. And a lot of that was because of the ballooning housing bubble. And most economists, mainstream economists, thought that that was the real deal. They thought it was a genuine recovery. Unfortunately, my research is showing that the same thing is happening today in many countries and sectors. So, the way a bubble recovery works is that the Federal Reserve, or the Fed, as well as other central banks, including Bank of Japan, the ECB, or European central banks, whenever there's a recession, they cut interest rates to try to create a new recovery. And then, if a recession is particularly bad, like the one we experienced 6 years ago, they'll even print money in the form of QE, or quantitative easing. So, after the dot-com bubble burst in the United States in the early 2000s, we had a recession, nowhere near as bad as the recession that we experienced in 2009. But it was a recession nonetheless, and because of that, the Fed cut interest rates and actually did create an economic boom. And that economic boom was our housing bubble. And that led to the recovery. So I believe we're basically repeating the same mistake now. It's not 100% identical to the one 10 years ago. It's similar to snowflakes. Bubbles are like snowflakes. No two are alike, even though they have a lot of similarities, a lot of parallels. So going further, just want to discuss this idea of how debt and asset bubbles create temporary economic growth. So the idea here is that when governments, corporations, and households borrow a massive amount of money and they spend it in the economy, it does create a temporary economic boom, but it doesn't end well. You don't create everlasting, sustainable prosperity by borrowing and speculating. See, so when central banks like the Federal Reserve reduce their interest rates, it reduces borrowing costs for corporations and households. And oftentimes they reduce the interest rates so low that it leads to a borrowing binge and that temporary recovery effect. And you see that borrowing binge actually occurring in a lot of different sectors now in the United States, like student loans, actually auto loans, believe it or not. Subprime automobile loans are actually really all the rage right now. I'll discuss this a little further in coming slides. Low interest rate environments also inflate asset bubbles from stocks to housing. Those bubbles create false economic optimism and what's known as a wealth effect. The bottom line is that when stock prices are going up, when housing prices are going up, consumers feel wealthier and they're more willing to spend money. And basically it creates this cycle where asset prices are going up and then people spend more money, and then that leads to higher corporate profits, economic growth, and so on and so forth. But it doesn't have sustainable underpinnings behind it. So I was just discussing and telling you that global interest rates are at record lows, not just in the United States, but this is across the entire world. We have a truly global economy. Everything is completely interconnected right now. So gone are the days where you could just look at the U.S. economy in isolation or the UK economy in isolation. Now, global stock markets and other financial markets tend to rise and fall in lockstep, and interest rates are no different. So I'm just using this example of the LIBOR. That's one measure of interest rates around the world. The LIBOR has been at record lows since the financial crisis. This is going on 6 years where it's been at virtually 0%. It turns out bubbles inflate during record low interest or during low interest rate periods, especially when they're at record lows. And just to show you this example, many of the worst bubbles and busts and also recessions can actually be linked back to this interest rate cycle. Going back, and this goes back much further than the chart that I have here, but just to show you an example, in the late 1980s, interest rates were relatively low. And during that time, a very dangerous bubble developed in Japan, as well as the US housing market. And then when the Fed started to raise rates and when other central banks started to raise rates starting around 1988, 1989, they hiked it all the way. Well, you can see the LIBOR went up to over 11%. And that actually popped the bubbles that were driven by those low interest rates. The popping of those bubbles led to a recession in the United States. It was known as the U.S. savings and loan crisis. We actually had basically a mini housing bubble in the United States that burst and wiped out a lot of U.S. savings and loan banks at the time. Also, Japan's stock market and real estate bubble popped. And believe it or not, 25 years later, they're still suffering. I'm sure many of you are aware, but their economy is still stagnating. A lot of it has to do with the debt and other imbalances that built up during that time. So the effect of bubbles and their bursts last a very, very long time. And then after that recession, the Fed and other central banks reduced interest rates to very low levels from where they were in the 1980s. And by the early 90s, around 1993, you can see we had interest rates were around 3 to 4%, at least in this example for the LIBOR. And during that time, a bubble developed in other parts of Asia, places like mostly in Southeast Asia as well as South Korea and Taiwan. You had it was known as the Asian economic miracle. And same thing in other emerging market countries, places like Mexico started to boom in the early 90s. But then when the Fed and other central banks raised rates, it popped those bubbles. And there was an Asian economic crisis around 1997, 1998. And same thing in Mexico. There was a crisis in Mexico and other emerging markets in the mid-90s. A lot of that had to do with rising interest rates. And then you can see the Fed reduced interest rates somewhat around 1998. And that helped to kick off the dot-com bubble. We had surging dot-com stocks, other tech stocks. And then the Fed raised rates again. And it popped, predictably. And then you can see what happened was, because of that recession, and then because of September 11th, etc., the Fed reduced interest rates even lower. Each time they keep on dropping them lower and lower and lower. And each time it creates a new bubble. So this time starting around 2002, 2003, 2004, that's when the U.S. housing bubble started to develop, as well as bubbles in Europe. You know, a lot of the problems that are happening in Europe, places like Spain, Italy, Ireland, you know, they're known as the pigs nations, basically. A lot of those problems stemmed from housing bubbles that started to inflate in that low interest rate period in the early 2000s. And then finally, when the Fed and other central banks raised interest rates, it popped those bubbles, and that led to the financial crisis that we're still basically dealing with. And finally, in 2009, late 2008, early 2009, the Fed and other central banks cut interest rates to an even lower level than we did last decade. This time it's at virtually 0%. It's been there for a record length of time. So not only are we at record lows, but we've been there for a record length of time. So we're talking almost 7 years soon. This time, I believe bubbles are developing in places like Australia, Canada, emerging market nations, which include places like Brazil, Southeast Asia again, Latin America, Central Asia, and so on. Even Africa, believe it or not. I believe a bubble's forming in app startups or tech startups. There's a lot of froth in that sector, as well as in U.S. stocks. I'm going to be just basically showing my proof for all these assertions in coming slides. So just going to show you a whole bunch of slides basically explaining my idea about these bubbles that are developing around the world. So you hear a lot of countries like Australia, Canada, and so on actually never really experienced that much pain in the financial crisis. A lot of the pain was centered in the United States and Europe. But now, this time around, the bubbles are developing in these countries actually that didn't experience that much pain. Because the consumers and the investors and traders in those countries were actually still relatively optimistic. And then once interest rates were cut, they were able to borrow, basically take on debt for record low interest rates. And what they did was they plowed that into the housing market and their stock market. So you can see Australia, housing bubble. You can see Australian housing prices have more than doubled in the past decade. Sweden as well. You can see each case, it shows the y-axis. It shows you it's not actually prices, it's an index. So the idea here is that around 1999, if this index was at 200, in recent years it's been about 550 or so. So you can see in many of these examples, housing prices continue to balloon. Switzerland, a lot of these countries are known as safe havens, but they have bubbles. Austria, look at this. In about 10 years, Austrian housing prices have doubled. Does that look sustainable to you? In each case, it doesn't make sense why these prices would have doubled. It's not like their population doubled. It's not like their economy doubled in value. The only change that has occurred has been interest rates have dropped significantly. And a lot of times, there's a lot of debt behind this, a lot of debt growth that's driving these housing prices. And I'll show you those charts shortly when I'm done with housing prices. Same thing, Brazil. And they're actually suffering quite a bit right now in the markets. You can see the Brazilian real currencies falling quite a bit. But Brazilian housing prices have quadrupled since 2008. Has their economy quadrupled? Not even close. Canada, another one. In 10 years, another double. And interestingly, here's a chart that actually compares Canada's housing bubble to the United States housing bubble last decade. So the United States is in blue, and the Canadian housing price index is in red. So you can see where our housing bubble peaked out last decade. And here, Canadian housing prices have far surpassed it. And this is all adjusted for inflation, too. So that's very worrisome. This is not something you hear a lot in the mainstream media. The mainstream media is basically completely ignoring these bubbles. I've been trying to warn about it. I've been blasting it out all across social media on my column. The rest of the media world does not want to hear it. They don't care, or they just believe it's not possible. They're in complete denial. And I hope you remember this webinar, because in a few years from now, you may come back and be like, I remember that guy gave that webinar, and now I'm hearing all about this global housing bust that no one was talking about. It's easy to spot bubbles. The problem is you're never going to hear about it in the mainstream media. That's one of the issues. Also, Canada has a debt bubble, and the debt bubble is even larger than the U.S. debt bubble. You can see the U.S. debt bubble right here in blue and where it peaked out in 2008. And here's Canada. What this shows is household debt to income. It's a household debt to income ratio. So you can see U.S. household debt to income basically peaked out around 125%. Canada right now is around 150%. I don't see how that can end well. One of the main reasons why Canadian debt has increased so much is because Canadians are borrowing to speculate in housing. So what they're doing is they're taking on these mortgages as well as also credit card debt, doing really what Americans were doing 10 years ago. They're just doing it with a 10-year delay, basically. China's another one where in the past 10 years, housing prices have almost pentupled or increased by a factor of 5. Colombia, look at this. It more than tripled. Housing prices in Colombia have more than tripled. And you can see it going almost vertical starting around 10 years ago, going parabolic. Finland, same thing. You can see after the financial crisis, their housing prices continued on up. Reason why is because of record low interest rates. It's cheaper to borrow, and people didn't want to invest in the stock market because they thought it was risky. So they said, oh, let's just go into housing. And we can get a really cheap mortgage, much cheaper than we could get before the financial crisis. And that's exactly what they did. Germany, too, believe it or not. Germany has been known for being fiscally responsible, but their housing prices have started to rise at a pretty aggressive rate in the past 5 years. And that's, again, because of low interest rates in the Eurozone right now because of the crisis. Hong Kong, I mean, look at this. Since 2009, their housing prices have increased by 2.5-fold. Not because the economy is booming or anything like that, but again because of speculation. Iceland, believe it or not, they had a big crisis in 2008. How come you don't hear about Iceland and its crisis? Well, they're experiencing a bubble recovery. Everyone's getting into property now. The good times are back. Everyone feels good because property prices are going up. India, housing prices are soaring there too. Housing prices have more than doubled since 2010. Indonesia, you can see this parabolic chart going up quite dramatically. And part of the reason why Indonesia boomed was because a lot of it had to do with China's economic boom. And China's economic boom helped to boost commodities prices. And that helped to basically create a lot of interest in Indonesia and also record low interest rates because it's throughout the world. So Indonesians are able to take on mortgages much more cheaply than they were ever able to do it. And now they're plowing into property, and that's why you get this parabolic chart. Even the U.S., you can see housing prices are going back. Same thing in the U.K. Actually, in the U.K., even though they've had a lot of financial struggles, their housing prices are actually higher now than they were before the financial crisis. Places like Uruguay, housing prices have tripled in the past 10 years. Malaysia, look at this parabolic chart. In about 10 years, prices have more than doubled. Taiwan, another one, almost tripled. Thailand, Turkey, I have so many charts. Israel, 50% increase since 2009. New Zealand, housing prices have more than doubled in the past decade. Norway, too, housing prices have more than doubled. And yes, this is recorded, no doubt. Yeah, we record all of our webinars. So, interestingly, I just discussed Norway, and I was discussing Canada before, and how Canada's bubble compares to the U.S. housing bubble 10 years ago. And I have a similar chart from Norway. This shows inflation-adjusted housing prices in the U.S. and Norway, and you can see Norway has blown past the U.S. housing bubble in terms of how inflated their housing prices are. And this all started basically around 10, 15 years ago, where you had just a surge of housing prices, and there's been almost no correction in housing prices in Norway. And you can see the same thing. They also have a debt bubble. They actually have their household debt to disposable income ratio is actually worse than the United States. And you can see here is the U.S. bust. And you can see Norway is even higher than the United States is, and that it continues to trend up higher and higher. Philippines, same thing. Past 10 years, housing prices have more than doubled. Singapore, same scenario. South Africa as well. South Korea. So I'm just going to briefly go through these other slides, basically showing debt growth in these different countries. And don't worry, I'll discuss all the tactical details of how to profit from this. I just want to make sure you're aware of the fundamentals, because you're going to see this ties into what's been happening this past summer. A lot of the emerging market countries have been plunging lately, and a lot of that has to do with the froth that had built up in those sectors, those economies, that now are starting to sell off. So we'll discuss that. But basically showing you private sector loans in each of these countries that I discussed, and you'll see in many of these examples that you'll see private debt has doubled and quadrupled in just 10 years. Australia, you can see, in about a decade, debt has almost quadrupled. New Zealand, same thing. It's all private sector debt, so that includes corporations and households. Binging on debt. Hong Kong is a particularly precarious debt bubble. China is notorious for that as well. Brazil, Mexico, Philippines, Indonesia, Taiwan, even the U.S., believe it or not. You thought we learned our lesson from the financial crisis? We haven't. We actually have more debt now. We're taking on more private debt, and a lot of that has to do with student loans. One of the biggest drivers of student debt growth or credit growth since the financial crisis is students going back to school, and they're taking on massive loans because education costs have never been higher. So they're coming out with $200,000 degrees to study baking and pastry arts. And I'm dead serious. I say this from personal experience. I've spoken to, I actually know someone who took on $200,000 in debt to go to a school to study baking and pastry arts. I mean, I don't know what the salary is in that kind of career, but I don't imagine it being much higher than $40,000 a year. I could not imagine holding a $200,000 debt load. That's like a mortgage. So that's what people are doing. They're not thinking. It's a lot of 19 and 18-year-olds who don't have the financial literacy to determine or say, hey, maybe this is too much debt that I'm taking on. So you have U.S. debt continues to rise. Singapore's private sector debt has doubled since 2010. And of course, they are being paraded as one of these miracle economies where everything is booming, everything is great. They basically escaped the financial crisis of 2008, 2009. You know why? Because they're taking on massive debt and they're building grandiose construction projects. So of course you're going to be able to create temporary growth. Give me $1 trillion, I'll create a heck of a party and create a temporary recovery, but eventually you have to pay that $1 trillion back. South Africa, same thing. Israel. So this is just a brief summary of different bubbles that I've identified around the world. Just going to go down the list. U.S. stocks, U.S. bonds, some sectors of the real estate market. Also, the tech sector, some segments of the tech sector, particularly in startups. You hear a lot of these stories about startups in Silicon Valley. You hear a lot about apps lately. And of course, the underlying technology itself is real. But I believe the business end of it is experiencing a bubble where just pretty much everybody and their cousin wants to launch a startup right now. And that's the kind of herd behavior that you typically see in a bubble. When everyone starts to jump to one side of the ship usually tips over. And that I live in New York. And I know so many people who are saying, I'm gonna launch my own startup now. Nothing wrong with startups themselves, but when everyone goes the same way, that's when I question, because I'm a contrarian. U.S. higher education, we discussed that basically, where total outstanding student loans in the United States have more than quadrupled to about $1.3 trillion in total just in the past decade alone. I mean, mind-boggling. And of course, you have education costs are soaring through the roof. A lot of that's funded by debt. U.S. healthcare sector, same thing. You have healthcare costs are skyrocketing. Of course, it's funded by debt. It's the U.S. government that's backstopping it, and it's U.S. government's taking on debt to pay for these for medical services that we would not be able to afford if we were not getting ourselves deeply into debt. And Carol, it's a good question. I don't know if you recall if I showed you UK housing prices. There's a particularly dangerous housing bubble in London. The rest of the country, housing prices have not gone up quite as much. They've gone up a bit, but there's definitely a London housing bubble. And a lot of that has to do with those record low interest rates, and also because emerging markets, places like Brazil, Russia, Asia, a lot of those countries that were booming, you have a lot of those countries, a lot of the wealthy people coming from those countries and moving to London, and it's been pushing up property prices there. So I'm concerned about property prices in London. U.S. subprime auto loans, believe it or not, people who really should not be able to borrow, people who have had a recent bankruptcy or who have really bad credit, are actually able to get subprime auto loans, and that's actually been driving the U.S. automobile sector has been one of the strong spots in our economy, but it's driven by debt. Also, shale energy, and this is a sector I warned about before it popped about a year ago. It's been popping essentially in the last year. In June 2014, about a week and a half before the oil top, I wrote a big viral report. You can actually Google it. Just type in Jesse Colombo oil bust, and you'll see my report on Forbes. I warned that oil was heading for a big bust, and that it would take down pretty much a lot of the shale energy sector, as well as shale energy junk bonds. That a lot of these companies in the shale sector were borrowing, and they were taking on debt in the form of junk bonds, high yield bonds. The problem is when oil prices burst and these companies' stock prices went down, the bonds went down as well, and their interest rates spiked. Also, bubbles in government debt. You have European government debt, Japanese government debt are actually, those bond prices are heading to record highs and their interest rates are going to record lows. And yet they've never been in more debt. I actually saw a study that said that global interest rates are at 5,000 year lows. This is coming from, I think it was a reputable bank like Deutsche Bank, was saying that basically they estimated throughout human history, and we're at, interest rates are at 5,000 year lows. And a lot of that has to do with because central banks are so desperate to create a recovery that they're buying government debt. Even though these governments are massively in hock. And let's say if you didn't have that kind of intervention on the part of central banks, bond prices would have crashed, because who wants to own bonds in a government that's in a lot of debt? Also, the biotech sector, if you look at biotech stocks in the United States, those have been soaring dramatically in the past 3, 4, 5 years. And again, there's nothing wrong with the underlying science of biotech, but a lot of times the business end and the investment end of these booms basically turns into a bubble. It devolves into a bubble when you have record low interest rates. It just creates a frothy environment. Same thing in China's economy, property market, debt bubble, etc. And China's boom and bubble has led to a bubble in high-end art, wine, spirits, and etc. So if you look at if you look at prices of art and other high-end collectibles, wine, spirits, they've gone through the roof. And it's because Chinese investors and speculators who made a fortune as property prices are going up, now they have all this money to play with. They have all this funny money to play with, and what they do is they go to Sotheby's and other auction houses, and they put in record bids for artwork. And I remember the Japanese were doing this back in the late 80s during their bubble. They were actually created a Japanese, they created an art bubble back then, and then it popped in the early 90s when their economy went into a recession. Same thing in emerging markets, as I said, places like Brazil, Singapore, Malaysia, etc. And also we discussed Australian property and credit, Canadian property and credit, as well as Nordic countries, places like Norway. I showed you how they have their debt and housing bubbles are actually more extreme than the U.S. was. And I just want to go in a little more detail into the U.S. stock bubble, and I'll discuss some tactical ideas behind how I believe in trying to profit from this, because I really do believe there's a way to profit from it. But it's probably not what you think, because it's gonna take some out of the box thinking. So you can see this is U.S. stock prices. They've almost tripled in the past 6 years. But the problem is they're overvalued. So if you look at a lot of valuation measures, and I'm a big fan of these measures, because they tell you if stocks are cheap or if they're expensive or if they're fairly valued. So this first example, this indicator is known as the CAPE, or the cyclically adjusted PE ratio, or price to earnings ratio, also known as the Shiller PE ratio. The only thing you really need to know is that it's the line on the top. It's this chart on the top where if you can see my cursor. And every time this indicator is above 20, if you can see that faint red line, that horizontal line, every time the indicator is above that line, the market is overvalued. And when it becomes very overvalued, bear markets or longer-term stagnation is sure to follow. It's just a typical phenomenon. This is going back over a century. At the same time, every time this indicator, this valuation measure is under 13, that green horizontal line, it's undervalued. That's a good time to buy. And when stocks become this cheap, it's a good time to buy. And you can see a lot of historic bull markets and bear markets started at times of overvaluation, undervaluation. So you can see in this example right up here at the top, and actually underneath this, the chart underneath actually shows the S&P 500. Actually, I'm sorry. Yeah, the S&P 500. So you can see in the early 1900s, the market was overvalued. And sure enough, we went into almost 2.5 decades of stagnation until earnings finally caught up with stock prices. Earnings went nowhere. And the chart I show at the bottom is actually not even adjusted for inflation. So if you actually had inflation there, it would actually look like a bear market. In a lot of these times where the market went flat, it actually was a bear market because anyone holding stocks would be losing due to inflation during these times. So you can see there was a bear market at that time until it finally became undervalued in the early 1920s. That was a very good time to buy in the early 20s. And as you know, the Roaring 20s started shortly after. And there was one of the biggest stock market booms in history at that time. Even though it looks very small in comparison in hindsight, that's only because of how much the market has gone up since then. But that really was a massive bull market in percentage terms. Sure enough, in the late 20s, it became so overvalued. You can see I circled it here. That was the overvaluation territory. And that told you, or anyone alive at the time, that there was likely to be a stock market crash soon. And that's exactly what happened. There was the 1929 stock market crash. And then finally, the Great Depression happened and stock prices went really low around 1932, 1933. And again, it was a very good time to buy right around that time. And then there was another bull market until about 1937. And that was the peak of the 1937 bull market. And actually, if you look up, it turns out the stock market became overvalued again. And then it crashed again. And finally, in the late 40s, early 50s, the market was undervalued. And that was a very good time to buy. And we went into a 2-decade bull market. Then by the late 1960s, it became overvalued again. You can see it was red circle I have here. And that signaled that the market was likely to experience either a bear market or a longer-term stagnation. And that's exactly what happened. Even though it doesn't look like a stock crash, it looks like stock prices went flat throughout the late 60s and 70s and early 80s. But there was so much inflation during that time that if you adjusted that for inflation, it would actually look like a big, steep bear market because people actually lost a lot of money. Because if stocks are going up, or if stocks are basically unchanged every year, they're not going up, but they're not going down. But the problem is, if food prices are going up 15 or 20% in a year, you're actually losing by keeping your money in the stock market. So sure enough, we had a secular bear market at that time. Finally, in the early 1980s, it became undervalued again. that was a great time to buy. You can see the very undervalued, and that told you a big bull market was ahead, and that's exactly what happened up until about 1999 when it became overvalued again and then crashed. So here's the problem: we're overvalued again. We're as overvalued as we were in prior historic bear markets. Now I know because you have this big peak over here because of 1999, the dot-com bubble. A lot of people then use that as a reference point and then say, "Oh, it's not as bad as 1999." So that means we're not in a bubble. No, that does not mean we're not in a bubble. It just means it's not quite as extreme yet as it was in the late 90s. It's hard to really top that just because of what we had in the dot-com bubble was driving everything at that time. But you look other historic bubbles and crashes, we're right at that level. The cyclically adjusted PE is at 25, and it was actually less than that back in the late 60s, and even less than that in 1937, and it was pretty much right at that level in the early 1900s. So that's very concerning. And here's another indicator in case you want to see more confirmation, more reinforcement. Here's a completely different indicator. This is actually Warren Buffett's favorite indicator. And what it is it's total US market capitalization divided by GDP, or gross domestic product. Basically what it does is it takes the total value of stocks in the United States and divides it by our GDP, which is basically, think of it as our national income for the year. So every time, similar to the other indicator, every time it's overvalued, every time it's above a certain level, in this case red, the red horizontal line, it's overvalued, and that signals that a likely bear market is ahead. Happened in the late 60s, told you it was overvalued. Sure enough, we had a bear market when you adjust for inflation. Finally, in the early 80s, it was very undervalued. That was a wonderful time to buy. Got a big bull market, and then it became overvalued once again back in the late 90s, and then happened there were actually two different peaks. There was another time of overvaluation back in 2007, 2008. We all know what happened then. And here we are again. We're actually more overvalued now than we were in 2007, 2008, and far more than we were back in the 60s. And this all ties back to those record low interest rates creating this frothy environment where people want to speculate, and they think just going long on the stock market means basically they can't lose. I know it sounds funny, but that's the psychology right now. Also, if you look at margin debt, margin, for those of you who are not familiar, is basically when traders and investors borrow money from their brokers to invest or speculate in the stock market. And you can see the past two bubble busts, coincided with a massive surge of margin debt. People took on a lot of money to gamble in stocks. It happened in 2000, 2007, and here we are. It's even worse now than it was even in 2007. Definitely very worrisome sign. So just want to discuss the key takeaways here. Stocks are very overvalued right now, and I believe that makes them an unsustainable investment. Sorry, it's an unsustainable bubble, which makes them a poor investment. There are a lot of traders or intermediate term investors who actually think they're geniuses right now. It sounds funny, but this is what happens with market psychology, especially after a 6+ year bull market. Keep in mind, you never want to mistake a bull market for brains, and also realize that in a bull market, a rising tide lifts all the boats. So there are a lot of people sitting on paper profits in the stock market who think they're smart, but they're not. It doesn't mean they're savvy traders. It just means that they happen to get lucky or bought in at the right time. But once that bubble pops, it's going to happen so fast that a lot of them won't even sell. Because a lot of times when a bubble pops, people think, oh, it'll go back up, and it goes down even lower. And then maybe there's a bounce, and they say, see, it's going back up, I'll hold, and then it goes even lower. And then eventually these people get pretty much wiped out. Many investors and traders have become so conditioned by the bull market that they'll get caught off guard when it pops, and they're going to lose a lot of their profits as well as their initial investment. How to survive the coming bear market. This is something I really put a lot of time thinking about. I also believe, it sounds kind of funny, but I think it's prudent to have some extra food stored over. I'm not saying it's something that would ever be needed, but in general, as a general philosophy, I like the idea of at least having some basic preparations. Have a little bit of food stored up, a little bit of water. You never know, but I've been thinking about how to actually profit from it. A lot of people think, oh, it's simple. You just short the bubble sectors. Here's the problem, though. It's very difficult to short in, or it's very difficult to swing trade when a bubble's popping. I believe the key is to be an active trader. That's one of the ways of profiting from it, as far as going short as well as going long. But my belief is that you want to be an intraday only trader, meaning you don't want to hold overnight. You want to trade in and out very quickly, and then by the time you're sleeping, pretty much be sitting in cash so that you're not exposed to overnight risk. Overnight risk is very high during a crash because a lot of the time central banks intervene overnight when you're sleeping. So you're in a position, let's say you're in a bear market and you short a lot of stocks that you think are going to go down, and you may be right for a day or two or a few days, and then all of a sudden, and this has been happening a lot, you'll wake up the next morning and find out that Bank of Japan announced an emergency stimulus program and the market's up 5%. And now you're short, and now you get wiped out or you're down significantly. I know, because I say this from experience. I've learned this the hard way, that swing trading is great in normal times, it's great in the bull market, but when things get really volatile, you want to be an intraday trader. So my belief is that as an intraday trader, you can profit from both the inflation of the bubble. Let's say we have another year or two where it keeps going up. You can profit from that inflation as well as the inevitable bear market or crash. Crashes can be extremely profitable. You can make a lot of money on them. There's no doubt about that. Volatility is very good for day traders. And I work for Cyber Trading University. Our CEO and founder, Fausto Pugliese, is he's known for basically trading in bear markets. He actually looks forward to it, as funny as it sounds. And in 2008, what he did was he shorted bank stocks. He did it on an intraday basis. He didn't hold overnight. He didn't do it as a swing trade. But each day the market would open, he would look for these short opportunities in these banks and basically shorted it for weeks and weeks and weeks and months on end as banks and other sectors started to fall. There's actually potentially millions of dollars to be made from that volatility, both on the way up, because we still have other bubble sectors that are still inflating despite the recent volatility this past summer. But you have to be a skilled day trader to do this. And I think there's going to be even more opportunities as a successful day trader going forward. It takes a high level of skill to get to that point just because it's going to be very volatile. And I just want to invite you, I'm going to be showing you some examples of some of the kind of day trading that we do at Cyber Trading University. We teach a lot of different trading methods. I myself teach Forex trading, I teach futures, I teach some options. Also, I've been learning, and I basically, Fausto trained me on this day trading system that we use. And we have a trading room known as the CyberGroup. It's a very popular, successful trading room where myself, Fausto, another instructor named Rich Lepis are in the trading room. And what we're doing all day long is we're looking for the most volatile stocks each day. Stocks that have both plunged and surged. And what we do is we put them on a watch list, and all day long we're looking for entry opportunities, both to the upside to go long and short. And we're trading in and out all day long. And we'll see a lot of opportunities to profit from these swings on intraday. And then by the end of the day, we're out. So we're able to sleep well at night. We're in cash. We're not worried about an emergency intervention by the ECB that happens at 3 a.m. when we're sleeping, or Bank of Japan coming in and causing a surprise freak move. And that's one of the reasons why I've really gravitated toward intraday trading. It's because it's actually less risky. A lot of people think, oh, day trading, that must be risky. I used to think that. And my thinking has actually completely turned around. I realized, well, any form of trading can be risky, but I like a form of trading where I only have to be in the market for 5, 10, 20, 30 minutes and then I'm out. It's just less time exposure, less time where something can go bad or something can go against you. You can control your risk more. So just going to show you some examples of the stocks that we've called out, and these are all recent examples in recent weeks of the kind of intraday trading that we do. And also, Carol, yes, I'm going to address that because I teach Forex and I do Forex updates in our CyberGroup room. So I'll discuss everything that we do in CyberGroup, but I just want to show you some examples of the kind of stock trading that we do. We have a lot of the traders in our room trade everything. They trade Forex futures, or maybe even come from a background where they only traded Forex and never even traded the stock market. But after they saw what we're doing, they said, you know what, that looks actually kind of interesting, and they got into it. So, as I said, what we do is we're looking for very volatile stocks that have a very high probability of making a strong move on intraday. And a lot of these stocks are biotech stocks or stocks that have had some sort of an emergency news announcement and they plunge. Or it could be both good news or bad news. We really don't care as long as we get that opportunity where we're getting a big volatile move. And we have a whole methodology that we use. What we're doing is we're following the smart money. We're following market makers, hedge funds, smart money, and other institutions as they're moving in and out. So we actually have a way where we're able to ride their coattails, believe it or not. It sounds funny, but we're able to do that. So here's an example of one of the call outs that we gave. This is based on, you can see right up here from our Twitter account. We put out these alerts 2 times a day. So we have the AM alerts where at 9 a.m. Eastern time or New York time, we put out our morning picks, or the stocks that have moved quite a bit that have a high probability of being very active that day. So one of the picks that we put out was AQXP. I mean, this stock was wild. This is just 2 weeks ago. And this stock, when we called it out, it was only around $3. It's a biotech stock. And they came out with some sort of bullish news. I think it was a phase 3 announcement or some sort of an FDA announcement that basically caused them to surge. And we were trading it all the way up. And this is all documented. Anyone who comes into the CyberGroup room can see that we're not calling this in hindsight. We're actually calling it before it happens. So in this example, what we typically do is we trade with 1,000 shares. That's like a standard lot size when it comes to trading. So we just use that as a standard, just for the sake of calculation. But you can start trading with 10 shares, 5 shares, 100 shares while you're learning, and then scale your way up to 1,000. We have some traders in our CyberGroup room who literally trade with 10,000, 20,000, and 50,000 shares a pop. People who are wealthy, who made money from this trading method. So you can see this AQXP stock. If you bought 3,000 shares, when it broke out, it broke above $3, and we saw it gave us a key signal that we were looking for. You put $3,000 into it, and within about a day, you could have made 50,000. Now I can see there was a market close at one point, so this actually played out from Thursday into Friday. But you can see it went from $3 all the way up to $55. We were watching it as it was going, kept on breaking above key technical levels each time. So that Thursday, you could have made around, I think it was just looking at the chart, around $7,000. And then that Friday, it went from 13 all the way up to 55. So every dollar, every point you make per share is $1,000 when you're trading 1,000 shares. This stock went from $3 up to $55. So just, you would have made $50,000 trading that. Here's another example. Again, another recent example. This is on August 3rd, 9 a.m. We put out an alert for another biotech stock called LXRX. And you can see throughout the day, just one, actually not even a full day. This was from the market open around 9:30 a.m. up until about 11:20 a.m. Not even lunchtime. This stock went from $11 all the way up to $13.29. So that's $1.80 gain in a half hour. So if you're trading 1,000 shares on that, you would have made $1,800. That's only an initial outlay of around $12,000 or $11,000 that you're putting into it. Not that you're risking all of it or anything, but to give you an idea of the return on investment, you make $1,800 in a half an hour. And it sounds funny, but if you see the CyberGroup, we do this all day long, where we're calling out these moves, and you're able to get in and out. And we also do it to the downside. We short as well. I don't have actually short examples, but that's the idea, that in the coming crisis, there's going to be so much volatility to the upside and to the downside, as well as the continued inflation of these bubbles, where there's so much opportunity. Like I mentioned, the biotech stock bubble. That's one of the reasons why we've been trading for the long side. We go long certain biotech stocks, short them. We go long on the way up and short them on the way down. You can see here's another example. This is a stock called Fit or Fitbit, and they make the heart monitoring and health monitoring watches. It was a recent IPO. It became very popular, and we called it out on August 3rd that morning. And you can see those swings all throughout the day. You can see if you're trading 1,000 shares, that's an $800 swing early on, short, another $1,400 swing to the upside, another $1,400 swing to the downside when we're shorting, another $1,800 swing to the upside, and so on. So you get these kind of moves all day long in these different stocks that are very volatile. The key is to know how to actually spot when there's likely to be a big move, and when to get in and when to get out. That's what we focus on. Another example, NVAX, another biotech stock that we called out on our Twitter at 9 a.m. Eastern Time. This stock surged $2.50. It went from $12.25 all the way up to $15 in just an hour, pretty much right at the open. On 1,000 shares, that's a $2,500 gain. That's pretty significant. We called it out right there. So just want to give you the opportunity, invite you to come into our CyberGroup room. We have a special deal where it's actually only $37. I'm going to give you the link. It's only $37 for a full week, and it's risk-free, where if you come in, you spend time in our CyberGroup, you see what Fausto and Rich and myself and the other instructors are doing. If you're not interested, or you think it's bogus for whatever reason, simple, call us up and say, I'd like my money back. I didn't like what I saw. And you'll get your money right back. So I'm very confident that you'll be impressed by what you're seeing, because we have a lot of professional traders who are doing very well, and you'll see the call outs that we're doing both long and short on these stocks. And I'm very confident that you'll be impressed by it. So click on the link. You can definitely order it from there on the website, or if you have any questions for me, email me at jesse@ctutrading.com, and we can get you started with that. Also, in addition to trading stocks throughout the day, I also do a daily Forex and futures update every day, 4 p.m. Eastern, when the stock market closes. Then I put my Forex cap on, and I start discussing ideas that I have about Forex, trade ideas, futures, etc. So there's something for everyone. So it's definitely worth it. Come check it out. And I hope to see you all there. So, all right, everyone, have a wonderful evening, and hope to work with you soon. Take care.